And thank you to everyone who's participating in the webinar today, where we're going to get a chance to talk about the first major change to the low-income housing tax credit program in quite some time, and its implications for state administration. Jim Tassos, my partner in crime here at NCSHA, and I want to especially thank our fellow panelists today, Tony Freedman of Holland and Knight, and Mark Shelburne of Novogradac and Company for volunteering their time and their expertise on this webinar, and for their contributions to the frequently asked questions document that NCSHA published a couple weeks ago. I think most of the folks on the webinar probably had a chance to take a look at that. These slides, I'm going to invite Tony and Mark to elaborate on anything that Jim or I say, and they're going to be able to answer questions that you all have. This webinar is really just the beginning of the discussions we're going to be having about income averaging moving forward. As always, NCSHA is a forum for states to share their experiences and their questions and perspectives as we begin to tackle this challenge of implementing this exciting new provision in the law. We will also be having several sessions at our upcoming Housing Credit Connect meeting, which is going to be in Chicago in June, that are going to focus on income averaging, as well as meetups at our meeting, where you're going to have the opportunity to talk to your peers about how they're handling income averaging implementation. So lots of opportunities to discuss this further beyond just this webinar. And again, please feel free to ask questions throughout. Also, if you've got questions that come up either after the webinar or questions that are more for your peers that you don't want to wait until Housing Credit Connect to ask, you can feel free to send an email to either me or Caitlin Harris from NCSHA, and we can disseminate your questions to the rest of your peers at other HFAs so they can respond to you in the meantime. We're in the process, as I think most folks know, of redoing NCSHA's website when we're going to have our virtual housing credit community back online, which will probably be sometime in June. But until then, please feel free to send questions to either Caitlin or me, and we will make sure that we get that out to everyone else. So we're going to go ahead and get started. And we're having a little delay on our slide. Yeah. We're having some problems that we're not having when we went through our practice mode. Okay. What is income averaging? Income averaging, basically, just to start at the beginning, is a change to Section 42 that was enacted in the Consolidated Appropriations Act of 2018 just last month, otherwise known as the 2018 Omnibus Spending Legislation. It is one of the two major victories that NCSHA and other housing credit stakeholders were able to achieve, and the other one, of course, is the 12.5% cap increase for 2018 through 2021. Both of these things are very exciting for us. Income averaging has long been an NCSHA legislative priority. It was, which is every year our board of directors goes through a process of setting legislative priorities, and this has been on the list for the last several years at least. So we're very excited to have finally been able to achieve it. Of course, now we have to implement it, so now is when it gets interesting. So income averaging is really intended to add new flexibility to the housing credit program. It's going to allow you to broaden the potential tenant pool for individual properties and better serve some of the harder to reach populations, make more deals possible in rural communities, better reach some very and extremely low income households who don't have access to rental assistance in a way that they're not going to be cost burdened. It's also a way of serving households in the 60 to 80% of area median income category, which I know a number of states are really interested in being able to do. Those folks, of course, were not previously eligible, but often desperately need affordable housing help. So the basics of what it is, income averaging is a new minimum set aside. It does not replace the 40 at 60 or the 20 at 50 minimum set asides that we've always had. Those are still there. It's simply another option that developers could choose instead. And it will allow qualified units to serve households earning as much as 80% of area median income, as long as the average limit in a development is no more than 60% of area median income. And of course, at least 40% of the units in the development must be income qualified in order to qualify for income averaging.
and that means income qualified, including those limits, those units that fall within the 60 to 80% range. In other words, you don't have to do 40 at 60, you have to do 40 at the average of 60.
That's correct. And it looks like we've got our first question from Richard Flanagan. We've taken you off of mute, so go ahead and ask your question. Richard, are you there? Star one. Richard, are you there? All right, then I'm going to go on, and Richard, feel free to type your question in as well if that might be easier. So it's important to note that income averaging applies to unit designations, not to individual tenant income. So you don't need to be figuring out this average and doing the math based on who the specific tenants are. Instead, you're going to be looking at designating the units at certain income levels, and that those designations have to be set at those 10% increments, starting at 20% of area median income. So it's 20, 30, 40, 50, 60, 70, and 80% of area median income. That designation is the maximum income that a household can earn to be eligible to be in a unit with that designated level. So a household, for example, that has an income of 42% of area median income at initial occupancy could live in a 50% unit, but not in a 40% unit. So that is basically how that will work. One thing that I want to make sure that everybody understands is that we strongly believe, we at NCSHA and based on our work with both Tony and Mark, believe that this, whether or not to allow income averaging is a decision that the state can make. It's really up to state discretion. However, we know that you are going to be getting probably a lot of pressure from developers and others within the community to exercise this option. And we've even heard that there are some folks who say, no, this should just be an option that you must be able to do under law. But we strongly believe that this is something that states really need to think about whether or not they want to do it, and if so, how they want to do it. There are a lot of questions for states to answer themselves. So I don't know if Tony or Mark or Jim, if you have anything else you want to elaborate on, just kind of those basic introductory remarks on income averaging.
Just a quick addition to your thought there, that I do imagine that pretty much every agency will have policies about income averaging going forward, but the real key time to be aware of the authority to use it or not is right now, when you've got projects at various stages of the pipeline, various stages of approval that might want to use it. That's the main reason that I've wanted the message of state authority to get conveyed, is because of that current pressure.
Well, there'll also be pressure going forward, as most agencies are either adopting or have recently adopted QAPs for this year's allocations, and even if an agency concludes it's not going to make averaging available to projects already in the pipeline, there will be a separate question that you will face as to whether and how to make it available to projects in this year's allocation rounds. But Mark's perfectly correct. The law as written, we think, allows you to make it available to projects in the pipeline, with certain caveats.
So here's just an example that I wanted to put up on the board just to make, for clarity's sake, because you can really achieve the income average in lots of different ways. There's lots of different potential math problems for getting to an average of 60% or less of area median income. So here's just a few examples to illustrate that. These are all obviously 10-unit projects, and in each case, you could get to under 60% with this setup.
And Jennifer, just to emphasize, what this would mean in this 10-unit project is that the owner would designate in advance Unit 1B is going to be, for example, at 80%, and units, eight designated units are going to be at 60%, and unit 3A is going to be at 40%. So that it's really a unit by unit designation. And as you will hear later in the call, there are questions as to whether the designations can float within a building or within a project. But there really will be unit by unit specific designations, which will require some adjustment in thinking to those of you who leave substantial flexibility to owners on low-income units generally in their project at the application stage.
So I have somebody who has their hand up. We're going to unmute and hope that this works. Gina Ferguson.
Hi, I'm sorry. We also asked it in a written statement. If you could just read our written question. Sorry about that.
Oh, okay. The question, it looks like, tell me if this is yours. Wouldn't the state have to affirmatively ban income averaging in its QAP to stop a developer from doing it? It seems that the state agency would need to opt out. Tony and Mark, do you want to speak to that?
Yeah, I don't think as a legal matter that is correct in the sense that as you think about this thing and as you look at the FAQs that NCSHA circulated and as we talk about it on this call, income averaging doesn't stand on its own. It operates in a fairly complex context, and there are a lot of questions that you have to answer. That said, given the level of interest in the option, it is certainly politic, if nothing else, to make a statement, and you may want to put that statement in your QAP, as to whether the agency intends to make averaging available, and if so, how it would be implemented. But I don't think, while you're perfectly correct, and as Mark indicated earlier, developers being shy types might suggest to you that come hell or high water, you have to do this. The fact is, as Jennifer pointed out, we think you have to make an affirmative decision to do it. And you probably need to tell people where you are to minimize ill feeling among your development community.
Yeah, again, I think you've got to separate, I think everyone's got to separate the two different categories of projects, the ones that are at some stage of application or award and any that might get built under future QAPs. And so I think with the first category of those, I don't think you need to have any kind of explicit statement precluding income averaging. I think that those have either applied or awarded under a set of circumstances, and they agreed to that. And so it's you have full authority to not have it go forward. But I completely agree with Tony that I think QAPs, if this is what I understand him to be saying, the QAPs going forward need to have some type of language on this. And I know that some of you are already under the gun trying to come up with language for that. And so that is something that I do think makes sense, because you wouldn't really want to be silent on something this new and complicated in your future policies.
Yeah, and let me add to that we recognize that each agency deals with its QAPs in different fashion. And some of you, for example, Texas, will actually have much of the allocation plan actually written into state law. Some agencies like California will do extensive regs. Some agencies will have more flexible QAPs. So we don't mean to suggest here that you have to do it a particular way, but consistent with the manner in which you modify and explicate your QAP to your various constituencies, we think it's desirable that you indicate what you intend to do in this area.
I'm going to move on to rent limits under income averaging. It's important to note that income averaging applies to both income and rent limits. That means that the rent limit on an 80% unit that's designated at that level is going to be 30% of 80% of area median income, and the rent unit on a 30% designated unit is going to be 30% of 30% of area median income, and so forth. That means that higher rent that's charged to the 80% unit is going to allow you to offset the lower rent that you're charging to the 30% unit or the 40% unit. And that's going to allow households who are living in a 30% unit and eligible for that 30% unit to better afford the rent without the need for rental assistance like a voucher. That's one of the things that's pretty exciting about this. So I don't know if anybody has any questions about rent levels. It looks like we might have one that's come up here from Ann Hamlin. Do you think each unit will have a specific income designation, or will it be a number of units at a specific income target, 10 units at 30%, but not necessarily a specific designation for each unit? That is definitely a big question. The question of how to designate units is one of the things we're going to talk about a little bit later in the webinar. But it's not clear in the statute what a requirement would be for that. And Tony and Mark or Jim, please feel free to answer that question as well.
Yeah, as I said earlier, I think it is probably expected that a designation will be announced for each unit. And you'll find, of course, that you can't monitor compliance unless your compliance arms know what the income limit and rent limit is for each unit. There's room to read the law more broadly, as Jennifer suggests, but I think as you read it, and then as you think about actually implementing it, you probably have to designate the limit for each unit going in. I think there's room.
So I'm going to turn this over to Jim for the next slide now. And I know there are a couple other questions coming in, but we want to make sure that we'll make sure to answer them by the end, no matter what.
Great, thanks, Jennifer. So let's go into more detail on state and federal implementation issues. This is something we've touched on a little bit already. As Jennifer mentioned, income averaging is allowable for new developments that make their minimum set-aside election after the date of enactment of the Act, which was March 23rd, 2018. The provision does not require formal action from the state agencies, IRS or HUD, but given the complexity of the provision, NCSHA is encouraging allocating agencies that intend to allow income averaging to provide guidance to applicants. And that guidance could be part of the agency's QAP or provided in other documents, depending on how you typically provide that guidance to your users of the program. An important thing to keep in mind is that the QAP preferences that are required by Section 42, including the preference for serving the lowest income tenants, continue to apply even in an income averaging scenario. So this is going to be tricky for agencies. You're going to need to figure out how to balance the additional flexibility that you gain by using income averaging, serving households up to 80% of area median income, with the statutory preference to serve the lowest income tenants. And that's something that in a minute I want to ask Tony and Mark to comment on that one in particular. While this provision does not require the issuance of IRS guidance, we do think that the IRS guidance could help facilitate the implementation of income averaging. So NCSHA has reached out to IRS and Treasury to discuss this provision. We're going to talk to them about the need for guidance, but also the importance of revising the IRS forms 8609 and 8823 so that they can address income averaging. IRS is working on that. They've already talked with the people in the Forms and Publications division of IRS. They know that this is a priority to try to get those forms updated as quickly as possible. Until IRS revises the forms, agencies have the ability to provide an attachment to Form 8609 setting forth any election, or an attachment to Form 8823 describing the non-compliance. This is obviously not something IRS likes too much. They don't typically like attachments to these forms, and that's part of their rationale for trying to get them updated as quickly as possible so they don't have to deal with these attachments. And then finally, we are reaching out to HUD as well to discuss the feasibility of providing income limits at each of the applicable designations. So from 20% of AMI up to 80% of AMI. Of course, the current income limits do not have all of those different variations. So this is something that we are talking with HUD about, whether or not they would plan to come up with new income limits for the housing credit that covers from 20% up to 80% of AMI. So let me stop there and see if any others have comments on some of these state implementation issues.
No, I'm good with that, Jim. The service gave us great guidance 30 years ago on how you got from 50% to 60%, and I think we can apply that that level of math to each level. So it's within the software that all of you now use, or otherwise Mark will sell you.
Well,
Another thing to keep in mind, though, on especially the 80% and the 30% designations, is that when HUD has its income designations for its other programs, not for the designations that it gives to the housing credit program, but the designation that it assigns as the extremely low income designation and the low income designation, most people would think low income is 80% and extremely low income is 30%. That is not necessarily the case. There are other things that go into it and into HUD's determination of what the low income and the extremely low income numbers are. So you can't necessarily say, I'm going to look at HUD's low income number as a proxy for what 80% is, or the extremely low income number as a proxy for what 30% is. That's one of the reasons why we think it would be very helpful for HUD to issue actual income levels at the 10% designations for the housing credit program, because we don't want there to be confusion on that.
That's really important, Jennifer.
All right, we've got another question from Mark Fleischer. And it looks like he's also written it in. Since the owner elects the minimum, are you there?
Yes, there. I apologize. On the income on the income limits, there's also, I think all you need to ask HUD to do is confirm that it's going to be based on the 50%, what they call their 50% low income limit, because that has all the adjustments in it. The real quirk is that in some high income areas, the 80% limit under most of their programs is capped by the US median, and you have to make sure that's not going to affect our program.
Yeah, Mark, I'd actually take that a step further, which is unless the service affirmatively tells us, or HUD affirmatively tells us that it's something other than 50% multiplied by 8/5, that we should just, again, work off of that that guidance we got 30 years ago.
Yep, I agree. And now that we're among friends, I can admit that Tony and I were part of a small group of 4 that saw an early draft of this provision and gave some thoughts on it. And I'm kicking myself on a number of aspects that we didn't think to include, one of them being creating a safe harbor for HUD's 80 and 30, but hindsight's 20/20. So for now, what Jennifer said is exactly right. You got to be careful not to presume that those are the right limits, particularly because at least for the 30% limit, the way HUD calculates ELI is materially above 30% pretty much everywhere in the country. So a property could have serious non-compliance problems if it were to use HUD's ELI instead of the way to calculate 30%.
And the code sufficiently defers to HUD in the calculation limits that if HUD were affirmatively to say 30% means this, that would probably stand up. But that if it's just saying extremely low income and so on, that, at least in my judgment, doesn't qualify under the terms of this provision.
All right, Mark, I hope that answered your question. I'm going to move on. I've got a number of other questions that are in the queue now. Matt Rayburn, his question is, since the owner elects the minimum set aside on Part 2 of Form 8609, i.e. this is not filled out out by the HFA, it seems the owner, not the HFA, would have to do the attachment to the 8609 to elected income averaging set aside. Any thoughts on guidance or format we should issue to owners on how to do so?
My thought is that the agency in the allocation process or in the M1D process for tax-exempt finance projects will get an indicator, and of course will write it into its extended use agreement of what the minimum set aside will be, and subsequent documentation is required to be consistent with that. Given the novelty of this provision, I think it is probably desirable for the agency, at the same time as it makes the option available, if it does so, to suggest how that should be expressed. You're perfectly right that it's an owner's election on a form, but that form is pre-created by the service. As Jim suggested, part of the way in which we are encouraging the service to give us new forms is because we know they hate for agencies and even worse for taxpayers to make up their own forms. So I think the stopgap, probably the best stopgap pending an IRS revision, would be for the agency to suggest the form in which those choices should be made.
Mm-hmm.
All right, I'm going to switch to the next slide. I know we've got some questions in here, but I think we're going to answer them based on just some of the commentary. So.
Good. Well, let's talk about eligible developments. And let's start with the easiest scenario, which is 2018 and future awards. So as I mentioned a minute ago, income averaging is available to new developments that make their minimum set-aside election after March 23rd of this year. So if you have a development in the pipeline so far in 2018 that indicated with their application that they would elect either the 40/60 or the 20/50 minimum set aside, but they have not yet received a carryover allocation, is it possible for the owner to change to income averaging? And our opinion here is that yes, agencies may allow this change. There's no specific federal prohibition against selecting income averaging as the minimum set aside after previously indicating that you were planning to choose one of the other minimum set aside elections. Now that said, what we're recommending to agencies is that they look at each situation and ensure that the following criteria are met first. First, that the QAP or other authorizing document should permit the change. Second, the change would not be inconsistent with the basis upon which the project was selected. And this really gets at whether or not there's an impact on project scoring. What you wouldn't want to do is allow somebody to make a change to the structure of a deal that maybe would not have allowed them to get an allocation in the first place over somebody else. And then finally, the third point is that the development's underwriting would not be adversely affected with switching over to income averaging. So this sort of change may impact or require submission of a new market study. Obviously, if you're changing the unit composition and mix, that may obviously have impacts on your market study. So agencies may need to develop policies on that issue. So before I move on to the older carryover allocations, maybe I'll pause and see if Tony or Mark or Jennifer have additional points on these current year awards. Okay.
I think you've got it covered, Jim.
All right, then let me move on to 2016 and 2017 carryovers. So these obviously got a carryover already. They do not have 8609s typically. And similar to the scenario above, agencies may allow a 2016 or 17 carryover that does not have a completed 8609 to change to income averaging. We would recommend in this case that you use the same criteria that I noted above, making sure your QAP allows the change, making sure that the change isn't inconsistent on the project selection criteria, that it wouldn't have impacted the scoring. And finally, that the underwriting wouldn't be adversely affected. So it's pretty similar to the current year awards. As long as there's not a completed 8609, you could treat them the same. Moving on, existing developments that have a completed 8609. Because the minimum set-aside election is irrevocable once made on Form 8609, existing developments that are already placed in service are not eligible to change their minimum set-aside election to income averaging. This is a place where we anticipate there will be some owners and developers that would like to do this, but we think it's clear that these existing developments are not able to switch over to income averaging. Finally, resyndications. You guys are seeing a lot of resyndications, and this is perhaps a tricky part of this. It is technically possible, but as we say on the slide, it's a limited applicability. So the tricky part here is to the extent that a resyndication includes new low-income units, an owner technically could elect income averaging as a new minimum set-aside. The new election would not free up the existing low-income units of their current obligation under the prior extended use agreement. So as you know, with a resyndication, there's an old extended use agreement that's already in place. That extended use agreement does not go away. So in the case of a resyndication, an owner would in effect have to comply with the more stringent rules that are applicable to each particular unit if it wanted to change to income averaging upon resyndication. And given the complexity of complying with two separate minimum set-aside rules, income averaging is not likely to be a very useful tool for most resyndications. As I mentioned, if there are new units, it's certainly possible, but if you've got existing units that are going to continue to be affordable, it's pretty tricky to try to meet two different minimum set-aside rules.
Jim, let me add to that probably the most frequent conversation I have with agency clients is whether and the extent to which they may change the requirements of their extended use agreements following the compliance period. And that said, and you know, we work hard to get necessary flexibility for the agencies on this. But if one looks at the extended use requirement, the one inescapable part of that requirement is that the applicable fraction, the highest applicable fraction used for taking credits during the compliance period, be maintained. And unless the service affirmatively tells us something different, which I would not expect them to do, as far as the original low-income units are concerned, that applicable fraction, defined as applicable to fraction is currently defined, would be expected to be maintained.
Thanks, Tony. Can you also comment, Tony, on tenants' rights under an existing extended use agreement and how that might be impacted in a resyndication?
Yeah, and we talk about this all the time. The tenants and prospective tenants have the right to enforce the extended use agreement after the compliance period, and assuming that they and their attorneys would interpret it as we interpret it, again, moving to the minimum set aside in such a fashion as to moving the minimum set aside in such a fashion as to affect the rents charged or availability of units to tenants could lead to litigation. As all of you have heard me say on a dozen occasions, there ain't no law on this. But I think Barbara would remind us, and will remind us eternally, as Stockton will do as well, that we really have to take the compliance obligation in the second 15 years seriously, and this is part of that continuing compliance obligation. So I would not advise an agency client to permit a redefinition of what is a low-income unit for the remainder of the extended use period following the compliance period. I think you're stuck with that unless and until the service tells us we have broader authority.
Thanks, Tony. Okay, let's move on to bond finance deals. So the Act modifies Internal Revenue Code Section 42 to allow for income averaging, but it did not make a similar change to Code Section 142, which covers tax-exempt bonds. So income averaging still may be used in a tax-exempt bond finance housing credit deal as long as the development satisfies both the income averaging minimum set-aside election and one of the minimum set-aside elections that are applicable to the tax-exempt bond financing, which is either the standard 20 at 50 or 40 at 60. So units with income limits above 60% or 50% do not count for purposes of meeting the tax-exempt bond minimum set-aside. Similar to the resyndication issue, trying to meet two separate minimum set-asides is pretty tricky. So in bond finance deals, this is going to be that much more challenging.
Yeah, I don't think it's going to be a big problem in the sense that we're really talking about 100% or nearly 100% low-income projects. So we'll, as a matter of math, meet the minimum set aside for the bond purposes. But it's important to point out, as you did, Jim, that this does not change the bond law.
Right.
Mark, do you have anything to add on that?
Just that my colleague Thomas Stagg ran various scenarios and took him a while to think of a way to have a unit combination that violated one of the two minimum set-asides. So while you'll have to always ask the question, you're going to have to try hard for it to be a problem. So that's good news.
Yeah.
Are you saying lawyers can do math, Mark?
Oh yeah, my colleagues can do math, but there's no such section on the LSAT, so that's not a strength of mine.
So let's move on to unit designation. I know there have been some questions about this that were in the queue, and I just knew we would be covering it, so that's why I didn't read them all out. Here's where I think things start to get a little bit more complicated. The code does not specify the process by which owners may designate units at specific income limits. So we don't have right now any kind of clear direction on when in the process you need to make that designation, how you have to make it. Really, we think that to a large extent at this point is going to be up to states to set what their process is going to be for designating specific units at specific income levels. And unless and until IRS provide guidance on this, that really is something that we believe that states have the ability to do. One thing we would say is that based on our conversations with Mark and Tony, we really think that we're encouraging states to incorporate unit designations into their extended use agreements and the carryover allocation, and to really think through how this is going to work best in the state and what the steps are that you're going to have to take. You know, we're also happy to help states that share their perspective with each other as to what their process is going to be for designated units. So again, please continue to use NCSHA as a forum for that. And we're going to talk about shifting designated units in a second. I just wanted to see about if Tony or Mark or Jim have anything more that they want to say about the unit designation process and any advice for states as they start thinking about how they want to do this.
Yeah, Jennifer, I would just modify my earlier note on the point by saying that clearly at the carryover allocation stage, an agency can be satisfied with mere numbers of units at 40, numbers of units at 60, numbers of units at 80. But by the time that you actually rent up units, certainly, it seemed to me that the unit by unit designations would have to be accomplished by the time that you finish that first year of the credit period. And at that point, if you executed the extended use agreement earlier, you may want to create an addendum to that extended use agreement specifying unit by unit, because again, you are going to have to monitor those units. And we have, we discussed among ourselves with limited success the extent and degree to which unit designations can float. But if you're going to monitor these things, as you will, you've got to know what the rent is for each unit, and you've got to know what the income limit is for each unit. But it can be arguably at the end of the rent-up stage, rather than when the things gleam in the owner's eye.
Right, and I would just encourage state agencies to try to preserve as much flexibility for the owner and yourself as possible along the way. And just because there could be unforeseen circumstances that come up, and you don't want to unnecessarily tie your hands.
So since the code obviously, as we just said, doesn't specify the process for designating units, of course it also isn't clear about whether a unit's designation can be changed or if it has to remain fixed. And by changed, I mean shifted or floating. What we do know, however, is that if you are doing mixed income developments with some market rate units, and I think using the term mixed income is always something that we've associated with market rate units, and I don't want it to get confused with the fact that we have a greater mix of incomes with an income averaging property. So here I'm talking about if you're doing properties that have some market rate units in them, there was going to have to be some shifting of unit designation because the next available unit rule, and the code anticipates this. I'm going to talk about that in just a second. But just starting off with 100 unit development, absent any contrary IRS guidance, states can decide whether to permit unit shifting, floating units. Some of the things that we're going to encourage states to think through include establishing a formal notice and documentation procedure so that you can make sure that this is really transparent as possible, and that the state is really on the same page and with the owner and the manager of the development, so everything's really clear. Also, and this is in this response to one of the questions that I see in the queue over there, there is no requirement for unit parity in the code. So if you have a 3-bedroom unit and that unit happens to be designated at 30%, there's no prohibition against switching that to an 80% designation. But this is an area where I think states are going to want to think through whether or not they want to set up policies around unit parity. Again, it's not a federal requirement, but something for you to think about on the state level. And then really importantly, we want to encourage development and compliance staff from the agencies to really work together to set up the policies, because there are implications on both ends around income averaging. This is something that's new and it's complicated to a certain extent. Hopefully in a few years we won't think it's as complicated, but at the moment, there are some complexities that we need to think through. And I think that really bringing both sides of state administration together to think through how you're going to do unit shifting, if you're going to do unit shifting, is really going to be important, because it certainly does make compliance monitoring more complex.
Yeah, I think it's always a good idea to involve compliance monitoring, asset management staff in policy development, but it's crucial in this circumstance, especially if a state has any notion of allowing a property to use income averaging and unrestricted market rate units. That is a level, that's a new level of complexity for owners and others to make certain remains in compliance with the code. And so you'll want to go into that. If you go into that, you'll want to do it with your eyes wide open.
I've got a question here that says from Mark Flesher again. Does it make sense to follow the pattern used for deep rent skewing in bond project deals and just list the units in the regulatory agreement up front and only modify at the end as necessary?
Yeah, Mark, I'm sorry?
I was just going to say, I hope you can take that.
Yeah, I think that it is simpler to do it. I don't think it's necessary to do it. In deep rent skewing, you're dealing with a different kind of market and perhaps a different set of objectives in which you've really got to know how to do it. Those of you who've lived with deep rent skewing now for 30 odd years know how to do that. I don't think this raises the same kind of complexity levels that deep rent skewing can, but and I also think that at the application stage and at the allocation stage, that owners may not know what each unit is going to look like and what the market's going to be for each unit. I think owners may also remember that you've got to go month by month during the first year of the credit period, and unless you're going to have to evaluate that month by month to see whether you hit the minimum set aside. So there is an argument for allowing owners freedom throughout the rent up period finally to hit their average, but as I said a few minutes ago, once you're through that first year of the credit period, you damn well have to know which unit is going to be at which level. And if you want to push that back earlier, you're probably making rent up harder for your owners, but that's life.
All right. So related topic, next available unit rule. The code provides some specific modifications to the available unit rule in the case of income averaging. This is, of course, something that you don't need to worry about at all if the development is 100% low-income development, but in cases if you do a development that has some market rate units. So basically, this is how it would work to the best of our knowledge. A tenant in a mixed income averaging property becomes over income if their income goes over 140% of the greater of 60% of area median income or the designated limit for their unit. So that means that a tenant in a 20%, 30%, 40%, 50%, or 60% unit, any of those designations would be over income if their income climbs up to more than 140% of 60% of area median income. But for tenants in a 70% unit, it's going to be 140% of 70% of area median income. And then, of course, for tenants in an 80% unit, it's 140% of 80% of area median income. So that's a little bit different, obviously, than the current standard, the other two minimum set-asides. But like with those other two minimum set-asides, if a tenant in a mixed income development goes over income, the owner must rent the next available unit to a qualified tenant. So the next question, of course, is what's the income designation that you're renting that next available unit at? So if in the case that there's the next available unit is already had prior to this been a qualified low-income unit, that unit's going to stay at its designated level, regardless of the designated level of the tenant whose income went up over income. So, for example, you have a 70% tenant, or you've got a tenant in a 70% unit is going over income, and then the next available unit that goes vacant is a 30% unit. The available unit is going to remain designated at a 30% level, even though the tenant that went over income was in a 70% unit. And then the reverse also is the case, that if you've got, let's pretend for a moment that the 30%, the tenant in the 30% unit goes over income, and the next available unit that comes due, that opens up is a low-income unit that was originally designated as a 70% unit. That unit's going to stay a 70% unit instead of suddenly becoming a 30% unit. So just designation stays the same. However, if the available unit that becomes vacant is a market rate unit, that unit's going to become a low-income unit designated at the income designation level of the tenant who went over income. So if it's a 70% unit that tenant that goes over income and the market rate unit becomes available, then that market rate unit then becomes a 70% unit. The question is what happens if multiple tenants go over income at the same time, and those units were at different designations? What do you designate that market rate unit as? And we don't know the answer to that. That's a question that IRS possibly could answer, but it's also something that, at least if IRS doesn't answer it, that states probably need to think about how they want to set those kinds of designation rules.
So there's actually a savings clause in the code itself there, Jennifer, in the sense that where you've got multiple over income tenants, assuming that you make the newly available, formerly market rate unit available to a tenant at a particular rent level, then the code then reminds us that you have to make sure that with the second available unit, you get back to the 60% average. So which is another reason that I felt that we are going to have to deal with floating unit designations. And yes, it is every bit as complex as it sounds. But the idea is to come up with policies that actually make sense in terms of the market that tenants are coming from, and in terms of the manner in which the agencies have to administer this.
Any other thoughts on next available units? I don't see any questions on that. I'm sure that people are probably just processing it because it is definitely something that is, I mean, I found it a little bit complicated. So maybe it's just me, but I think that that's one of the areas of real complication with this particular new provision. If not, we're going to...
Jennifer, I think it's worth saying that those of you who are sitting there saying, what in the hell did he mean by that? Know that you can call with follow-up questions after this is over.
Absolutely.
So I can move on and go into some of the compliance considerations.
Hey, Jim, before you do, I just had a question that popped up on the screen that related to that, and it says, if you have no market rate units, do you have to hold the restricted units vacant?
If you have no market, the way the available unit rule works is that if you are in a 100% low income project, you will always rent the next available unit to a qualifying tenant, and therefore the available unit rule is not triggered. You then run into the vacant unit rule if a unit is vacant at the end of the year, whether you made reasonable efforts to rent that unit. But in a 100% low income project, an over income tenant really doesn't generate an available unit rule question so much as a vacant unit rule question.
Right, and you wouldn't even really know because you wouldn't be doing research on 100% low-income property.
Well, and that's a separate discussion worth having, Mark. I mean, because those of you who are not monitoring existing tenants in low-income unit, in 100% low-income properties, understand that you can do that in an income averaging property, but you do have to take into account the designation of each newly rented unit. You don't have to recertify all your existing tenants, but you do have to watch that 60% average is maintained.
Right.
It's definitely going to mean a little bit more challenging with dealing with waiting lists. So as you try to get eligible households into whatever income designation a unit is, it's something that managers are going to have to pay attention to.
Mm-hmm.
All right, I think we've answered that question. So Jim, why don't you go ahead with the compliance?
Okay, so income averaging raises a number of issues for agencies to consider relating to compliance monitoring, and we have covered a number of them already. In the absence of IRS guidance, agencies may choose to develop policies on allowing shifting of unit designations in 100% low-income developments, and this is the issue that Jennifer went into detail already on. The second bullet here is dealing with compliance monitoring fees. Some agencies may decide that they want to charge higher fees to income averaging developments, and in this case, if an agency determines that it does want to charge higher fees, they really should just specify the fee level in the QAP or whatever other documents cover monitoring fees at the state, so that people are clear that those additional fees would be charged. Moving on, an agency may conclude that in order to assess compliance of a development with income averaging, it would need to have more regular tenant income verification, and this is particularly true in 100% low-income developments where you may not be getting that level of detail on those units. And this is the issue that Mark and Tony just commented on just a minute ago. The multiple building projects, this is a challenging part. And this is something that when we were first developing the frequently asked questions document, this was an important question that was posed by a few states, and we addressed it in the FAQ. How can a state ensure that a 60% of AMI average is achieved for a project under IRS's definition of a project without knowing whether the owner will treat buildings as separate projects or make a multi-building election on Form 8609? So in the frequently asked questions document, what we recommended is that agencies require developers to address this question with the application. The agency may choose to require an owner to state in advance what unit distribution it intends to apply to each building and show that the income averaging is achieved for the defined projects within the property. Really, this is an issue that Matt raised a minute ago from Indiana, and Tony already commented on this, but it really is going to require a level of designation that we're not used to in some of these deals, and it's particularly tricky with these multiple building projects. The final point here is agencies needing to develop clear policies on non-compliance reporting. So if a development elects income averaging and fails to meet the income averaging standard at the end of the year, it's not a qualified low-income housing development for that year. So this non-compliance has to be reported to IRS on Form 8823, and the owner could be subject to a loss of credits. We expect that the IRS will revise Form 8823 and its instructions accordingly to address this. It's important to note here, though, that targeting under income averaging differs from deeper targeting under the 20 at 50 or 40 at 60 minimum set-aside elections. If an owner elects one of the other minimum set-asides, but commits to deeper income targeting, for example, at 30% of AMI for a portion of those units, and they did that for scoring purposes, Non-compliance with the deeper income targeting is not a reportable event on Form 8823 because it's not a federal requirement. There still could be an issue with the state agency, obviously, because you're not doing something that's in the extended use agreement. But from IRS perspectives, it's different in income averaging because maintaining the average of 60% of AMI in an income averaging property is a federal requirement, and therefore non-compliance with that provision could trigger a loss of credits.
Jim, I was thinking about this too. I often tell both agency clients and owner clients that given the rules on casualty losses, you should always be sure to have your fires and hurricanes early in the year so that you can replace all the damage by the end of the year. Oddly enough, nobody ever obeys. Similarly, in multiple building projects, you should make sure that the higher income units are hit by the hurricanes and fires rather than the lower income units, because unless NCSAJ gets what it's asked for on casualty loss, or unless you can get everything repaired by the end of the year, you could conceivably, by virtue of a casualty loss, throw a whole project out of compliance just because you blew the average. So do those hurricanes early, guys.
Good advice, as always. Anything else on these compliance considerations before we move on to potential IRS guidance issues? Okay. So as I mentioned, NCSHA is discussing income averaging with Treasury and IRS officials. And our hope is to coordinate a formal response to them relating to the need for guidance on this provision. Instead of having every state come to them with particular questions, what we would like to do is work with you guys, as Jennifer mentioned at the beginning of the call, to come up with what we think is a set of questions where we'd like them to provide guidance. A couple issues that are potentially on the table. What process should states use for designating units? We've talked a lot about this, and whether or not those unit designations can be changed over the course of that deal. The next bullet, what happens when one unit is out of compliance and that causes the average to go above 60%? We're going to need to figure out how to address that issue. How to apply the next available unit rule when multiple tenants in units of different designated income levels go over income at the same time. This is another one that I don't think we have a clear answer to. This may be a place where we can come up with some guidance, but it may be something that ultimately would go into some IRS guidance. And then finally, while legislation is clear that income averaging does not apply to existing developments, we really are asking agencies to consider whether there's a public policy rationale for some application of this rule to existing developments. The answer may be no, and this may be something that ultimately we decide doesn't make sense for existing developments, but we do want to have those conversations. Finally, we undoubtedly will need IRS guidance on reporting of non-compliance with income averaging. This could be something that can be addressed in a revision of Form 8823 or its instructions, or potentially in a revision of the Form 8823 guide that IRS has provided. So there may be a way that it wouldn't be part of a formal guidance project from the folks in the Chief Counsel's office, but we may be able to get some guidance from IRS in the form of 8823 form revisions, instructions, or the 8823 guide.
I think basically when it comes to IRS guidance, we need to make a determination with the state, with all of our, the HFAs on, what are things that we think states need to be able to set their own policies on? What are things that we really do need the IRS to give us some sort of clear guidance on? And then more specifically, what do we think the IRS should be saying as an answer to those questions? Because we would want to work closely with the IRS in the development of that guidance and give them our perspective on how they should come out. And so all of those are things that, we're very interested in hearing from you about. You don't have to say that, right now what you feel that you need guidance on or anything like that, but please continue to reach out to Jim or to me with your thoughts about where guidance would be helpful, especially as you start going through the process of developing your program and, thinking through all these various implementation questions. This is a day, you must tell us by X date. IRS does have every year an opportunity to provide guidance on their priority guidance plan, but that doesn't mean that that's the end-all, be-all of our opportunities to talk to them about what our needs are on this. And so I think it's a continuing issue for a while, but please continue to send us your thoughts and questions as we move through this and get a little bit more information. But what we don't want to have happen is for the IRS to hear from every state individually and have kind of different perspectives. Some states might feel, oh, we really need guidance on this issue, while another state doesn't want the IRS to rule on it because they want to be able to set their own policies. All right, I'm going to just open it up to questions. There are a couple that are sitting here that I'll just go through that have to do with rent limits at the moment. How do rent limits work with Home and National Housing Trust Fund? And basically, I think the answer to that, and Mark and Tony, please jump in if you think I'm wrong, is that you've got to do both. You've got to ensure that whatever the more restrictive rent requirement is met if you've got those other sources of funding in your property.
Yeah, Jennifer, I think that's exactly right. You may, because home projects with home may have specific home units. You probably, if you're going to designate specific home units, you probably want to tailor them to what fits best with the income averaging approach chosen. But yeah, you've got to meet every applicable constraint.
Right, and there's even differences within HUD programs. I mean, Home and Section 8 don't necessarily have the same limits, and so the site managers are going to have to follow all of those and do whatever's the most demanding.
Mm-hmm.
And then the only other question that I have sitting in the queue at the moment is, I think in regards to rent levels, and it just says this is similar to HERA, and I'm not sure, I think there might have been more context to this that I'm missing, but I think it has to do with HERA special rent limits and just the complexity of that, and I don't know if anybody else wants to comment on how this would fit in with HERA special rents or different income designations.
You are operating with, I assume that's a question about the hold harmless provisions of HERA. And the best that I could say in the abstract is that what HERA deals with is definitions of applicable rent limits and income limits in particular projects. And it ordinarily doesn't apply to newly designated units. So I would think, and there's enough expertise on the listener side of this call to correct me if this is wrong, but I would think that a project newly contemplating the use of income averaging would not be operating generally under the HERA hold harmless provisions. So we might avoid at least that level of suicidal complexity.
I've got another question that's come up. Will HUD add the 70% and 80% income limits to the MSSTP income limit? and this is a question from Angela Lowry, we will be talking to HUD about the need for them to set these additional income limit levels to make this a lot easier. In the meantime, I think we're just doing the math, unfortunately. I don't know if anybody else has anything they want to add on that.
The math is good. We have clear IRS. You know, my position is IRS has told us how to do this, and unless IRS or HUD in its designated capacity under the code tells us to do something different, we do the math.
Yep. Another question, this is from Melissa Levi. Just to clarify, when someone selects income averaging on Form 8609, are they completing the AMI designations to average 60% for only the minimum 40% of units or for all housing credit set-aside units? Can the development income average all of the housing credit set-aside units, i.e. including those above the minimum?
That's a really important question, and it's one that merits a little bit of explanation. The point is that the income averaging designation is based upon all of the low income units in a project. And as Jim pointed out earlier, that doesn't necessarily apply to non-averaging designations of lower income that owners make in order to get allocations. But if you made an income averaging election, then what you are doing is governing all the low income units in that project, and the average of 60% of median has to be maintained across the designations of all the low income units. The cautioning we were doing earlier about not falling below 40% is the same caution that you've got on a non-income average project. It may be 100% low-income project, but if you fall below 40% at 60%, you have blown not simply the credits for the over-income units for the particular year, but you've also thrown the project out of minimum set-aside compliance. Jim's point on this is that if you blow the average on a year, you're not simply putting at risk the over-income units, but if you blow the average such that you don't meet 40 at 60 for the whole project at the average level, you are putting at risk the project's qualification as a qualified low-income housing project for the particular year. It is the average which determines whether you have met the minimum set aside under the income averaging test. So I think the best answer to that question is if you have income averaging, you've got to meet that as an average of all the low income units.
I think that answers that question. Another question here, can you explain again why AMFI bands cannot float? What is the reason for that? Anybody want to jump in on that?
I'm not sure I understand the question. I've seen in doing the webinar on Tuesday, there are some folks with some housing authorities that put their questions in terms of bands, and I don't know that depending on what someone means by that, it is potentially a not helpful concept, because it's that each unit has a designation is the way I think is important to think about this. And the question of how those might change or float over time is, I hope we've conveyed there's some degree of uncertainty as to how that will work.
Well, but let me just underline what Jennifer had said, which is the position that we are suggesting be the baseline for states is that you do have the discretion to permit low-income units, the designations for low-income units to float. The statute could be read either way, but you theoretically you could permit a unit upon vacancy to change its unit designation unless IRS tells us to the contrary. It is certainly possible to read the code as saying that once you designate an income limit for a unit, that's it, you're stuck. I would not go that far. But the bottom line is that you cannot monitor compliance in a project unless you know what the income level is and the rent level is for each unit. So even if you conclude, as we have said you can conclude, that income designations can change unit to unit, you then have to answer the question of how you are going to follow that. How often are you going to permit it? Under what circumstances are you going to permit it? and how you will get that information to your compliance monitoring folks so as to minimum homicides within the agency.
I've got another question here that is from John McCormick. It says, what about Section 8? Can an owner collect contract rent so long as the tenant pays no more than 30% of their income? Would tenants' share be limited to applicable AMI rent levels if 30% of income was greater than that rent? And I think that the answer to that question is, at the moment, Section 8 payments are still excluded from rent. So if the FMR is higher than the housing credit rent, you could continue to collect the full Section 8 payment. However, as everybody knows, this particular provision, while it was enacted as part of the Omnibus Act, also is included in the Affordable Housing Credit Improvement Act, the Cantwell-Hatch, or now Corbell-O'Neill bill. And in that bill, there is a provision that says that if a property elects income averaging, the maximum rent is the housing credit rent, even if there's a voucher recipient, and you cannot collect voucher payments above the housing credit rent. That piece of it has not been enacted as of yet, but that is something that is in the original legislation that you should be aware of, because should we be able to get the rest of that legislation through, that would be part of it. And that would impact income averaging.
It would kill income. Mark Flesch, you don't have to worry about it. You don't have to worry about averaging if that passes. Every deal that I see that involves Section 8 vouchers has the expectation that you'll collect the voucher, maximum voucher rent applicable to the unit, not the tenant payment. So under the code, as long as the tenant payment is within the applicable rent limit, you're okay. The point at which HUD begins adjusting voucher rents to the tax credit limits, then we're really going to have some very interesting consequences for our project.
And then the last question that I have here is from Lori Lindberg. And Lori, I think this is actually something that is probably best if I circulate to states so they can reply to you directly. Lori says, I'm interested in hearing from other states about whether they are considering amending current QAPs to incorporate income averaging. What timelines are other states anticipating rolling out guidance to developers? And I think that that's a discussion that we need to have, but since you need to have it with other states and taking folks off mute will probably be a little bit difficult. What I will do is send that out to our housing credit community as a question and have folks reply all, because I think everybody would be very interested in hearing that. And I think that that is really all we need. I don't believe there are any more questions in our queue, so I think we've gotten through it in just under an hour and a half. Tony, Mark, Jim, I wanted to know if you wanted to make any final comments before we finish our webinar.
Well, yeah, I was actually in response to Lori's question. I was just in Minnesota, and so yeah, there are some states that are in some tough spots. They had to put their policies out very recently, right after income averaging came out, and so that was definitely difficult for them. And so other states have different timing, and so they'll be able to potentially have more of an opportunity to work this in. And I'm working with a few states on QAPs, including income averaging, and so I'm very happy to share thoughts on that with anyone, for free, because that's how we got to be in getting this kind of thing worked out. So please let me know if you would like some help and have some questions about how this can work for your policies going forward.
Yeah, the only thing I'd add to that is that this really should be the beginning of the discussion. It's not intended to be the end of it. And that NCSHA and quite frankly all of us working in the area need to learn more and think more and hear more in terms of how this can work. You are going to walk away from this call, and aside from being grateful that it's Friday afternoon and didn't go on for another hour, you're going to walk away from this with hopefully more questions than answers, because this really is the beginning of a discussion of a fairly complex provision.
Mm-hmm. And Jennifer, I'll just add a point that you have already stressed, that this is the beginning of the process, but we're going to continue these discussions. We really want to hear from states leading up to the Housing Credit Connect meeting in June about what you're thinking about this provision. I want to figure out how we can best use our time together in June to talk about this at the meetups and also during the sessions. We have a number of different panels during the public part of the meeting where this will come up, including a panel that Tony's going to be on, Compliance Hot Topics, and a panel that Mark is going to be on mixed income developments. But it's going to come up in a number of different contexts throughout the meeting, including during our roundtable. So we want to think about the best way to spend our time together in June. So we're going to be reaching out to you to try to figure out how to structure our roundtable discussions to make sure we can do that. And we'll continue our work with IRS in the meantime to figure out what they may be able to say either by June or in advance of that meeting.
Thanks, Jim. So I want to just thank everybody for taking part in this webinar. We were very happy to be able to provide it, and we really appreciate Mark and Tony for joining us for this and giving your expertise to our members as we begin to really tackle this really complicated and yet very exciting new endeavor within the Housing Credit Program. Our slides, if they're of interest to you, we're going to send them out to everybody who registered. So they will be available for you, and please feel free, of course, to reach out to either Jim or to me on any of these issues, and we will do our best. If we can't answer your questions, we'll try and direct you to someone who can. But we're very pleased to be able to do this today, and thank you all very much.